Hello investors and traders, today I'll speak about three best dividend stocks to buy right now. Today I'll speak about the oil and gas sector, and of course we'll tell you about nice three dividend stocks from Oil&G to buy right now. So let's start with the first company for today is Chevron Corp with the ticker CVX. Now its current price $150. Its dividend yield is around 4%. So look, in my mind, before let's have a look on its technical analysis. Last 3 years the stock traded in the uptrend, so now we are testing this trend line, and of course if we will break it, it can be it can finish very steadily, but still here is a great possibility, great opportunity to see bounce from this trend line and to see this stock much higher. Also the RSI, the momentum indicator now is 40, telling now us that the stock already were sold. So another good opportunity to buy the stock. Of course, let's have a look on its fundamental parameters of the company. So the forward dividend yield is about 4%. It's a huge company, market cap about 300 billion bucks. So I remind you, this company engaged in the provision of administrative, financial management and technology support for energy and chemical operations. It operates throughout the upstream and downstream segments. Let's have a look on its valuation. So P ratio now about 8 and PS ratio, price per revenue, is about 1. So look, the average for S&P 500 15, so this company is twice cheaper than the whole market. So in my mind, it's not expensive at all. Here we see, of course, a strong decreasement in 2020, but I remind it was a stock market crash. It was crazy when if I'm not mistaken, the oil price went in negative price levels. But now we see that for the last 3 years the marginality and of course the revenue is increasing very significantly. By the way, if we will compare 2018 and last year, the revenue increased very significantly. Just in 5 years we see a raise about 50-60%. It's meaning that the revenue rose about 10% per year. Of course, I think it's very positive. The marginality now, gross margin 21, in net income 15. Any problem with it? If we'll check the revenue breakdown, so downstream about 73% and upstream it's 26%. And remind you, downstream and the production of oil, of other minerals, and the upstream is selling, the marketing of of its products. More than 50% the company selling in other countries, in international, and in the US about 45% the revenue the company gain in US. Let's have a look, of course, on the dividend history. So the dividend yield is 3.9%. The dividend increase track record 37%. So it's impressive history. Actually, in front of us we see a dividend aristocrat. Dividend aristocrat, it's a company that increases dividend payments in consecutive more than 25%. So also the annualized 3-year dividend growth rate is more than 6%, and the dividend payout is only 32%. So here, look, dividend, what we got here, dividend aristocrat, nice dividend growth, and of course low payout. It means that only 32% from its net income company pays as a dividend. So here I see a great and nice room for Chevron, CVS company, even to increase its dividend payments to shareholders. And of course, let's have a look on the financial position. Here, look, it's also a nice picture. The amount of debt is decreasing. 3 years ago it was about 50 billion bucks. Now for the last year 27. So now the Fed fund rate is more than 5%, and it's a very good performance of the management company. It's telling us that the management company is seeing and watching all the risk, all the market risks, and decreased for last year's amount of debt on the balance sheets. For me, it's a very good sign. And by the way, please pay attention to the amount of free cash flow. Here it's even 38 billion bucks. And also, of course, let's have a look on the cash flow statement analysis. I would like to pay attention to the amount of free cash flow. Free cash flow is usually the amount of operational cash flow minus the investing activities and the amount of dividend the company paying. So the orange one is free cash flow. So for the last 7-8 quarters, any problem with paying its dividend, we see that usually the dividend payments about around 3 billion bucks, and free cash flow it was 12 billion, 8 billions. For the last quarter is 4 billion. So yes, maybe it here decreasing, but anyway, I'm no doubt that the company could find 3 billion bucks quarterly for paying it dividends payments. So here in my mind, Chevron, a great dividend stock in your portfolio, dividend yield more than 4%, the dividends here very safe, the very strong cash flow statement, and of course now the stock, this company already down more than 15%, so in my mind it can be a nice opportunity. Let's have a look on the second company for today. It's Kinder Morgan. It's also oil and gas company. It operates in oil and gas pipelines. It's a sector. The dividend yield is here quite impressive. It's about 7%. The chart, we see trading in increasing channel. Now it's situated, it's trading in the lower border of this channel. So here it can be another opportunity to buy the stock. Let's have a look on the fundamental parameters for this company. So market cap 37 billion bucks. It's a smaller company than the Chevron, of course. It's engaged in providing pipeline transportation of natural gas services, and of course it operates in natural gas pipelines, products, pipelines, terminals, and CO2. So generally, of course, it's some kind of middle stream company in oil and gas. The valuation here is 15 PE. It says it's in the range of average S&P 500 and the PS, price per revenue also 2. I think if the marginality 13, so the PS also, the price per revenue is okay. The revenue for this company continued to grow for the last years. The marginality 13% is also okay. We saw Chevron was 15, so general it's okay. Most of its revenue company earn natural gas pipeline 65%, and products pipelines about 17%, and 99% of its revenue company earn, of course, in the US. If we'll check it dividend history, so we see that at least for the last 5 years the company increased dividend payments, and of course it's a positive sign, and dividend yield very close to 7%. Here the payout ratio very close to 100. It's a little bit high, but anyway, I think it's an interesting player and an interesting stock in the US oil and gas market. Let's have a look on the next stock for today. Is Valero Energy with the ticker VLO. I traded this company in the COVID crisis, I remember. So look here, it was down to 33 bucks. Now it traded higher than 100. So look, it's performed more than 200%. So it's really a lot. It's 200 per 3 years. So their gain could be about 70-60% per year. So believe me, it's a low. And don't forget, of course, the dividend yield. Now, of course, after such strong performance 3.6%, but still in my mind it's a nice dividends. So look here, the Valero market cap is very close to the previous company. The previous company, I remind you, it was Kinder Morgan. So Valero actually in the same range in terms of market cap. Dividend yield 3.6. The valuation, look, the valuation very cheap, only 3 PE. In my mind, of course, it's very cheap. Maybe it's connected here. Look, the net income jumped from $1 billion to $11 billion. Maybe it was the reason, but only look, please have a look at on the boost in the revenue. Usually it was 100 billion, 114, but for the last year it 176. So it's very impressive grow in the revenue and increasement in the marginality of this company. Most of it's of course it's as I told you, it's a midstream company, so it's earning the refining of oil and gas products. The dividend, the dividends here for me it's quite and nice figure. The company increased dividend payments. It not increase. Last 3 years it was actually the same level, but the dividend per share, but still 3.55% for me is quite enough. Here a strong and positive moment. It can be a payout. The payout here is 11%. It's very low. So here it's a huge possibility for the company to increase the dividend payments. And also, as I told you previously, here when the stock price was about 40-50% per share, it was a few years ago at the pandemic period. So the dividend yield was very close to 7%. Here it was 5%. So for me it's impressive. So just I told you the stock performance was for example 200%, but we should also add to this the dividend yield, so 6 plus 5 plus this year, so it's actually about 215% in total. Let's also have a look on the debt. The amount of debt is decreasing. It was $15 billion 3 years ago. Now it's only it's lower. It's less than 13. And look at the impressive increasement in the free cash flow. It's also for me it's a good sign. I'm a hunter. Telling you the truth, I'm hunting for this company, Valero Energy. I put attention on this company maybe 3-4 years ago. And as I see, it's attractive, very attractive player in the refinery market, US refinery market of oil and gas products. So generally, to recap, the stock price is down more than 25% from its high levels. Now we still traded in the uptrend line. The dividend yield around 4% for me is quite enough, and also the revenue and the net income, so it's actually the marginality of the company is increasing, and for me it's as a dividend investor, as a receiver of a stable cash flows, the passive income, for me of course it's very good parameters. And the last stock for today is Enbridge. Actually, telling you the truth, I made research on this company. I wanted to add her in our shortlist for today on the oil and gas stocks, dividend stocks. But look here, the dividend yield more than 7%. Look, it's very dangerous. Also, the payout ratio is very close to 100%. So actually, the most probably company raising debt for paying dividends. It's not a good sign. So for you, I deep dived to this company little bit more. So look, the Enbridge company, it's a Canadian company. The debt to EBITDA ratio is very close to 7. It's a lot, and interest coverage in my mind 2.5. It's not enough for me to add this company in my dividend portfolio. Also, the Altman's score is less than 1, so the probability in default in the future years it can be a warning sign. It's elevated, so that's why telling you the truth, I'm prefer not to invest in this stock now. Also look, the current ratio, quick ratio, the liquidity ratio less than 1, so also it's look very very dangerous. And the amount of debts, look, the cash here is very very low, much lower than the debt. No, here for example the amount of cash to debt is less than 1%. So this company, so generally speaking, Enbridge, although it has a dividend yield more than 7%, but it's the reason actually why the company has such dividend. It can be at any time after each quarterly report, it can just cut the dividends, maybe twice, maybe per 3 times, and of course you may not receive those dividends. So my dividend stocks for today is Chevron, very strong player in the oil and gas market. It's Kinder Morgan, another nice company with a dividend yield about 6%, and Valero, one of my favorite companies in the oil and gas market, with a strong free cash flow, with a strong fundamental. These 3 companies I prefer to buy now after a nice correction on it share prices. So of course, if you like this video, don't forget to press the like button, subscribe to my channel, and see you on the next time. Bye.